How do qualified and non-qualified dividends impact your taxes? Imagine earning money from your investments and wondering how much of it the government will take in taxes. That's where understanding qualified and non-qualified dividends comes into play. When you receive dividends from stocks, they are considered taxable income, but the way they are taxed depends on their type. Qualified dividends are special because they meet certain rules set by the Internal Revenue Service. These rules include being paid by a U.S. corporation or a qualified foreign company and holding the stock for more than 60 days within a 121-day period around the ex-dividend date. When dividends qualify, they are taxed at lower rates, which are the long-term capital gains rates. These rates can be 0%, 10%, or 20%, depending on your total taxable income. For many investors, this means paying less in taxes on their dividend income, making it more efficient for building passive income over time. On the other hand, non-qualified dividends, also called ordinary dividends, do not meet those IRS rules. These dividends are taxed at your regular income tax rates, which can be as high as 37% for high earners. Non-qualified dividends often come from sources like real estate investment trusts, master limited partnerships, or foreign companies that don't meet the criteria for qualified dividends. Because they are taxed at higher rates, they can increase your overall tax bill. From a passive income perspective, the difference between qualified and non-qualified dividends is important. Qualified dividends let you keep more of your earnings because of the lower tax rates. This helps your investment grow faster since less money is paid in taxes. To maximize this benefit, investors should aim to hold dividend-paying stocks long enough to meet the IRS holding period requirements. It's also good to remember that any dividends paid are reported on IRS Form 10999 division, which separates qualified from non-qualified dividends. This makes tax filing easier and more accurate. Keep in mind that even if you reinvest dividends through plans like dividend reinvestment plans, you still owe taxes on the dividends earned that year. In summary, qualified dividends are taxed at lower long-term capital gains rates, which makes them more tax efficient for passive income strategies. Non-qualified dividends are taxed at higher ordinary income rates, which can increase your tax liability. Knowing the difference helps you plan your investment and tax strategies better, so you can keep more of what you earn from dividend stocks.